How borrow costs, float, and volume combine to ignite short covering. Let's strip the hype out of short squeeze talk and actually break down how a true short covering rally forms, why low float is the accelerant, and what signals tell you the pain has crossed the point of no return. This isn't about meme stocks, it's about mechanical stress inside the market. Initial setup: how short pain becomes forced buying. A short covering rally is not driven by optimism, it's driven by involuntary demand, the chain reaction. Shorts enter on weak fundamentals or dilution risk. Float is too small to absorb positioning. Borrow tightens, fees spike, liquidity evaporates. Price rises just enough to trigger margin stress. Prime brokers force partial covers. Covering itself becomes the dominant buy flow. Price dislocates violently from fundamentals. At the peak, there are more shares owed than available to trade. That's when charts go vertical. The Tinder fire engine. Why low float is the non negotiable ingredient. High short interest alone is meaningless without float compression. The float reality check. Metric: danger zone. Free float: less than 20 million shares. Elite setups: less than 10 million. Short interest, percent afloat, greater than 25%. Critical, greater than 40%. Days to cover, greater than 3 days. Explosive, greater than 6 days. Institutional lockup, greater than 50% held tightly. Insider ownership, high plus restricted selling. Low float means shorts cannot exit cleanly. Any buying causes immediate price discovery. Market makers widen spreads. Gap risk explodes. Spark the engine. The technical triggers that flip the switch. Short covering rallies do not begin at highs, they begin at levels shorts are leaning against. Primary technical ignition points. First, volume expansion at key resistance. Break of a multi-week VWAP or anchored VWAP, 3 to 5 times average volume, close above resistance, not just an intraday spike. This tells you new buyers have entered and shorts can no longer cap price. Number 2, failed breakdown, the Widowmaker setup. Stock breaks support, shorts pile in, price reclaims that level within 1 to 2 sessions. This creates instant negative gamma for shorts. Number 3, borrow stress signals. Cost to borrow rising rapidly, greater than 30 to 50%. Shares available to short drop towards zero. Intraday borrow recalls. This is when time works against shorts, not for them. Number 4, options-driven acceleration, gamma layer. Heavy call buying just above spot, market makers forced to delta hedge, price pins higher, shorts lose control. The real inflection points, fundamental catalysts that force repricing. The best squeezes come from fundamentals shorts dismissed as impossible. High probability catalysts. First, non dilutive capital events, debt restructuring, asset sale, strategic investment, royalty/licensing deal. This destroys the short thesis overnight. Number 2, unexpected revenue inflection, contract wins, government deals, AI/HPC capacity monetization, regulatory approval. Shorts rely on time, revenue removes that weapon. Number 3, float compression events, reverse splits and no dilution, buybacks in microcaps, going private speculation, insider accumulation. This is when float math breaks entirely. The pain threshold, when covering becomes mandatory. Shorts don't cover because they're wrong, they cover because risk managers make them. Forced covering conditions. Loss exceeds risk model tolerance, borrow cost greater than expected downside, liquidity risk greater than directional risk, prime broker margin calls. At this stage, price action becomes discontinuous. Fundamentals no longer matter short term. Identifying stocks ripe, not just heavily shorted. The checklist that actually works. Structural setup. Ultra low float, high short interest relative to float, rising borrow costs, tight institutional ownership, technical pressure, holding higher lows, volume stepping up before news, failed breakdowns, reclaiming key moving averages, fundamental asymmetry, shorts betting on dilution that doesn't arrive, mispriced optionality, AI, IP, assets, binary event with asymmetric upside. If all three align, you don't get a grind, you get a vertical repricing. Final truth most miss. Short squeezes aren't rallies, they're liquidity crises. The winners aren't the loudest tickers on social media, they're the ones where supply disappears, time turns hostile, and exit doors shrink. That's when short pain stops being theoretical and becomes forced buying at any price.